Good morning, everybody. Welcome to today's 1Million by 1Million Strategy Roundtable for Entrepreneurs. 1M1M, as you know, is the first and only global virtual accelerator for startups in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that mission, we've been doing these free mentoring roundtables for a lot of years now. They started back in 2008, the fall of 2008, when my first book came out and we started experimenting. And then, you know, all these other things happened. 1Million by 1Million in its current format came together in 2010 and was launched at the end of 2010. But all along, we've kept these roundtables going. So this is the 371st session. The event is being recorded. You will be able to access the recordings at our YouTube channel, 1M1M Roundtables, and also on the blog. By the way, the Roundtable channel on YouTube has all the recordings of past roundtables, so you'll find a tremendous amount of learning material on that channel if you would like to, you know, spend some time listening to stuff. If you have a commute or whatever, these are good fillers to learn from while you have downtime or driving time or metro time or taxi time, whatever. If you're live tweeting the show today, please use hashtag 1M1M. Our Twitter handles are at 1M by 1M and at Shromana, and we publish a lot of very rich, very interesting content all the time. So if you follow us, you will be able to access all of that. On your screen are the call-in instructions. This is a roundtable. We do want you to participate as much as possible, and we would like you to dial in and spend time talking to us, weighing in, introducing yourselves, asking your questions. But we're not quite ready for that yet. We will get to that, but we'll put the slide back up and invite you to do so a bit later, but keep the questions in your mind, keep formulating the questions. Participation is how you learn. We are going to start today's 1M by 1M session with a conversation with Sunil Bhargava, who is the founder and managing partner of Tandem Capital. Sunil, welcome to the show.
Hi, Sharmana. Good to be here. Thanks for having me.
Pleasure. Tell us about Tandem. What is the focus of the firm? How big is the fund? What size investments are you making?
So this is we are currently investing out of our third fund, which is Tandem 3. It's a $100 million fund. Our first check is usually $1 to $2 million in late seed deals, where the company is usually raising $2 to $5 million. We invest in companies that have discovered a business or in the process of discovering scale. They are not focused on a particular sector or technology. Instead, we look at the business and like to invest in teams where the timing is right for channel innovation.
So let us talk a little bit about what types of ventures have you invested in, so we get a feel for where is your sweet spot, where is your center of gravity. Industry sector, B2B, B2C. You've talked about stage a little bit. I would like to double click down on the stage, but we'll do that in due course. Let's go one step at a time.
Yeah, so we've invested in a bunch of different markets. As I said, we're not focused on, you know, a particular technology. It's not like we are focused on enterprise, or we're focused on mobile or Bluetooth and so on. What we are focused on is kind of your channel and how you go to market and what your product and channel innovation is. So to give you an example, we have a bunch of investments in the construction side, and one of them is a company called Deco, which is out of Seattle, and they're in the home smart home space. And there are lots of companies in the smart home space, including companies like Nest and so on. But these guys' thesis was that you have smart switches, which cost $75 to $100, and you have dumb switches, which are the ones that you see most commonly in homes and offices. And the dumb switches cost $2. So when a builder has to put in, 1,000 of these or 100 of these switches in a home, he's not quite ready to take a $100 cost. So these guys have made an upgradable switch. So the builders can put in switches at a very low cost, pretty much close to what their dumb switches would cost. And then when somebody buys it, they can very simply upgrade the home by putting in these cartridges that make these upgradable switches smart. So that is a very different go-to-market. They are very attractive to people building new homes. So we look for innovation like that.
What is the go-to-market for a company like that, to give us a flavor of, what is the go-to-market innovation?
Yeah, so their go-to-market innovation is that, for new home builders, there's a very simple value proposition. If you spend $200 extra bucks per home, which is peanuts when you're building a home, you can now have the ability to say that it can be made smart when somebody buys it. So in the model home, they can show all the smarts, and then if somebody is interested in buying it, they can just say, yeah, we'd like to pay whatever the upgrade fee is, and then somebody who's a minimum wage worker can go in and plug in the modules, or they can do it themselves at a later stage. And it's also future-proofed. If things change, they can push out the Bluetooth cartridge and put in the Greencoot cartridge. So what they've done is they've made the selling and installation of smart homes a marketing cost as opposed to a reasonably big building cost for home builders. So that enables home builders to make the decision much more simply, which enables their go-to-market to be much easier than others.
So from their point of view, it's still a B2B deal, though. It's not a B2C deal.
Yeah, actually, in our second fund, we did a lot of B2C companies. In our third fund, it's much more B2B or B2B2C rather than B2C.
Okay. And what trends are you seeing in your deal flow? This is not necessarily what you've invested in, but what trends are you picking up based on what comes to you right now?
So today, the ecosystem for investing in very early stage companies is very robust. This is the phase where companies are building their MVPs and discovering their business. There are accelerators like Y Combinator, Techstars, StartX. There are many $5 to $50 million funds. There's angels, angel lists. So the number of companies that are getting enough of a slug of capital to get their act together and find the initial seed of their business is tremendous. So, when we go to a YC demo day, there are 100 odd companies there, and StartX has another 20, and there's so many different accelerators, and we get things from AngelList and so on. So all of these are, so that the quantity of deal flow is exceptional. There's also a lot of market disruption that's going on. There are different ways to reach businesses, there are different ways to reach customers. So there's a lot of opportunity too, but finding that right team, with the right timing and right focus is still not easy at all. So we don't make, that many investments. In a year, we probably will do about 5 or 6 investments in a year, but we see probably 20 to 30 times that many companies that we meet with, and there's obviously way more than that are out there.
So the question is more about trends in the, let's say 200, 400, 800 companies that you see, what are the trends? What are people working on in your deal flow that are interesting?
I think it's extremely broad. I mean, even if you look at just what we've invested in, we have companies in the construction space, we have companies in the food space, we have companies in the transportation space, we have enterprise infrastructure companies, and this is, so I think, now you hear a lot about blockchain, which is disrupting trust companies. So I think it's a very wide spectrum. I think the best way to kind of get a sense of the breadth of the companies is just go and look at the variety of different types of problems that are being addressed by, a single YC class. So you look at that and, they have 100 companies in there. There are B2B, B2C, global, people are funding. Like one of the companies we're looking at right now is funding student education. So it's all over the place. I don't think there's, and that's why we are focused on channel innovation, because that's kind of the commonality of most of these things, is that the ones that just build a better mousetrap have a harder time breaking out into venture scale companies. The ones that have channel innovation in addition to product innovation are the ones that tend to break out. And because of Facebook and Google and other mechanisms, inside sales is becoming simpler and better. So all of those things are leading to different ways of selling and but you have to get a very clear value proposition for the buyer. You have to know what they're buying.
So would it be fair to say, in the types of entrepreneurs that you are interested in investing in, channel innovation is one of the key requirements?
Absolutely, yeah. For us, that is very important. If you're just building a better, another better mousetrap, probably people who understand that particular mousetrap are good investors for that. We kind of look at how is the ecosystem for selling products like that changing. Yeah.
Could you also double-click down on stage for us? You said you put in $1 million to $2 million in a $2 to $5 million round.
Yeah.
So what?
Go ahead.
What are you looking for? Like, if it's a SaaS deal, for instance, are you looking for a certain ARR number, which a lot of funds today have kind of benchmarked on what ARR numbers they would come in at, or if there are other sectors, you have certain metrics that you are anchoring your investments to?
Yeah. So, the first stage, which is prior to where we come in is where the team comes together, you build enough of a product to demonstrate that there is a business here. And you have a thesis as to how this business is going to grow to a big size quickly enough. So when we come in, we look at it, so, in SaaS, one would assume that to get to your A round, you need to have probably $1 million in ARR with 50+% margins and a 3x growth rate. So if you're at 300K right now, you've got to be at $1 million in 12 months. So what we look at is, in a marketplace, it might be something different, where you could say that, if you had $1 million a month in GMV, you had, about 12 to 15% margins, and say in 3x growth over the last 12 months, that would be something that the Series A guys would be interested in. So when we invest, we look at your, what evidence that you have that shows us that you can get to some of these numbers in 12 months. So usually we want to see our deals get from where we are to a Series A in, 9 months on average. Some might get to it in 6, some might get to it in 12, some might take a little longer, but that's kind of what we look at. So what we want to do is we want to kind of fund that level of, so based on what your go-to-market is, what numbers we think the Series A guys would like to see, that's kind of how we look at it. So give you an example.
So you don't consider yourselves a Series A investor?
No, we don't consider ourselves a Series A investor. We usually, because at Series A today, people expect evidence of scale. So they want to see significant growth, 3x growth. That's really important because fundamentally, if you're in a really big market, if you go and tell them, oh, we have a $20 billion addressable market, and if you're growing at 1x or 2x, there's no evidence that there is actually a really big addressable market. So most of the Series A guys, at least the quality Series A guys, are looking for growth. A lot of the companies that come to us have shown that there's a business. They are very clear on why somebody is willing to pay them money. And they have a thesis that this is how we can expand the growth. They've got a few things in place. Take, for example, one of our companies called Outdoorsy, which was in the RV rental space. When they came to us, they were a marketplace company. They didn't own any RVs. They had 100K in GMV. So they showed that there was, a reasonable, there was a business. But that wasn't an interesting business to any Series A company. But we understood the innovation both on the channel side and the product side. And now, they've done, I think last month they did 20 million in GMV in like about 14 months. So that's the kind of, that's an outstanding example, but those are the kind of things that we are interested in seeing.
So the numbers that you quoted, like a 1 to 2 million investment in a 5 million round, from the universe that we operate in, people are not ready to raise a 5 million round before a Series A usually. So that's what I find a bit confusing in how you position yourself as a fund.
5 million is at the top end. Usually they're 2 to 4 million. There are some, like we invested in a company called Capability, and then they ended up getting into YC. They raised about 3 million when we put in some money. And now they're going to raise like a $6-7 million round. But the key thing was that they didn't have traction in terms of they didn't have an operational system in place. They built some stuff, they got some prototypes done, they got some pilots going, but they didn't have a clear, thing of scale. So it just kind of, if you have scale, then that's when the E-round guys are very excited about you. It's not so much about the money. The money you may need less. You may need more if you're producing hardware like Deco is. You need more money. If you're doing something like Outdoorsy, you need less money. But it's kind of more the stage of the business. So how much have you proven in the business? Have you proven that there's a business? Have you proven scale?
So you are, let me see if I can parse this right, because we are really trying to understand the positionings of the funds who come here to explain their positioning. And, right now we have all kinds of permutations and combinations from pre-seed, seed, post-seed, pre-Series A, and you're kind of positioning yourselves as pre-Series A. So the difference that you are highlighting, I think this is what I understand, is that you are pre-Series A in that the company has shown traction but not acceleration. Is that accurate?
Correct. Yeah. So we want to show that you can scale because it's, you can sell a little bit of pretty much anything, but if you fund a company that's not going to grow fast enough into a big market, whether you hit the wall in Series A or Series B, you're going to hit a wall at some point.
Yeah.
So
Absolutely,
really
and most companies are not suited to venture capital. Their most hyper growth is not a natural state. They're rare companies they're very rare companies that can achieve hyper growth.
Absolutely, and that's why we see a lot of companies, and we only invest in a few. And I don't think that in Silicon Valley sometimes people feel that they have to raise venture money. I don't think that that's right at all. I think it's not an indication that you have a good business. It's just an indication that you potentially have something that could be hyper-growth. And when we bet on companies, we are betting on the fact that these founders are signed up for hyper-growth and they have a shot at it. And what's going to happen is if they don't, then the investors and the founders are going to be unhappy, which happens to a lot of companies.
Happens a lot. It happens actually to most of the venture portfolios. So very few outliers actually end up successful and make the fund equation work. The rest of them fail to achieve hypergrowth. What about geography? What is your footprint? Where do you like to invest?
So this is kind of our third year of investing. So in our first couple of years, we invested in companies in many geographies. We have teams from Mexico, Canada, Portugal, Eastern Europe, from India. But now we are in this later stage of the fund. I think we need to, we don't have as much time luxury, so we are pretty much focused on the U.S. markets and U.S. companies. But, in investing, if there's a really good company that comes up from anywhere, definitely will listen.
And I imagine you have all these companies, even if they are in the U.S., they often have an offshore operation that is doing a bulk of the engineering. It's a very common trend at the moment, right?
Yeah, I think at our stage, I would say about 25% of the companies have that. If they are from different countries, then definitely they do. If they are from the U.S., they tend not to, at our stage, have that. But going forward, most of them end up doing that.
But, what we see also is a huge number of companies that are starting elsewhere and then coming to Silicon Valley or to some part of the United States to actually raise later stage capital. And I'm not even saying later stage as in Series B, Series C. I'm talking late early stage capital. Simple, even Series A, Series A. They're building products elsewhere. They're selling from elsewhere for the first couple of years and then coming here to raise money. So that's a very, very big trend at the moment.
Yes, we see a reasonable number of that. I mean, given that, I have connections in India, as probably you do, we see a lot of companies coming out of India that are trying to do that. We haven't invested in too many of those, but I think for a long time, India was focused on the B2C market. It's just over the last year that they've finally focused on the B2B market. So we're seeing a little more of that. But you're absolutely right. There are a lot of people coming in. And we are open to that. We just did a Canadian company that was, that came in. They actually still have their offices in Canada. They haven't moved to Silicon Valley, but they're doing good stuff.
There's a lot going on in Vancouver, especially because the visa situation is a much easier one in Canada.
Yep.
But what are some of your notable companies? You've mentioned a few along the way. Have you had exits, for instance, that you would like to discuss?
I mean, we've had tiny exits which are not worth kind of really discussing, but we are too early in Fund 3, you know, we're in the third year of investing, so it's too early for big exits. You know, some of the things that we did in, I think in Fund 2, like Outdoorsy is going to go out and raise its Series B. They're doing phenomenally well. I mean, obviously, you know, one of the things is that exits now are coming at exits in the form of an IPO or an acquisition are coming at much bigger valuations. But, you know, so some of our companies are getting to the Series B level. A lot of them are getting to the Series A level. In Fund 2, we had a company that was actually based out of India. The two founders were here. It was a U.S. incorporated company, but most of the team was in Bangalore. It was in the gaming space. It was called Bash Gaming. They own the largest bingo franchise in the world on mobile. They were doing about $8 million a month in revenue, and they exited to Game Show Network for about $160 million with only a couple of million invested. So that was a good exit. Another one of our companies was Tile, which makes a little dongle that you can attach to your keys or put in your wallet and so on that helps you find things. That's doing really, really well, but I don't think they are planning to exit. They'll probably try and go for an IPO. You know, we have a lot of promising companies, but nothing exited.
And what is your most promising company in the portfolio currently?
That's a tough question. I think the one which, from a revenue perspective, is furthest along is Outdoorsy. They're at a very...
That's the RV rental one?
Yeah, they're at a very high run rate. And it's, you know, these marketplace companies, the interesting part about them is that they have a very exponential growth curve. So they start out slow, and then once they hit the formula, then they grow very, very rapidly. Obviously, their margins are not as high as SaaS companies. So the SaaS company curve and the marketplace company curve is quite different.
How do you process the current investment climate where capital is moving further and further upstream? And as I said earlier, we have all these, you know, different blends now of pre-seed, seed, both seed, pre-series A, series A. How does a seed investor, pre-seed investor, or an entrepreneur mitigate the Series A gap? By the time you go through so many rounds of financing, you've already lost so much equity in the process. How do you view all this?
I think, you know, you have to have a very, I think a lot of people, the first thing entrepreneurs should realize is that investors do not invest in products, they invest in businesses. So I mean, I have so many people come and talk to me, and, you know, the first 20 minutes or 25 minutes of the conversation are about their products. And you've got to get to the business very, very quickly, both in your mind, and that's what you should focus on. I
completely agree with you. We teach all our entrepreneurs to focus on business.
Exactly. So I think you know, if you're focused on business, you have to raise capital to get rid of you know, some business risk. So initially, you know, you want to know what people are going to, if you have a thesis that people will pay for X, try and validate that thesis and raise the least amount of money to validate that thesis. Now, if we say we have, you know, whichever investors, irrespective of what they say, if you tell them that this is what you do, they'll say, oh yeah, this is kind of the business risk we want to take. So in our case, we say, hey, we are willing to take risk on scale. We're not willing to take the risk on, do you have a business? We used to be, you know, Tandem 1 and 2, and even in the early starts of 3, we were willing to say, hey, if you have a good space and you're a good team, we will bet on finding a business along with you. So I think if you go down that path, the venture community is, or the investment community which consists of angels who have, just based on how they're feeling on that particular day, they will listen to your story, and if they like you, if they like the business, for whatever reason, they will write you a check. It's up to you to not raise too much money and reach the next milestone. If you don't reach the next milestone, that's when you really get hit with significant dilution.
Yeah.
If you have, yeah.
And I think, there's a mindset problem that we constantly struggle with because our work is very early stage work. So there's this obsession with raising capital, and we constantly trying to make them unlearn that obsession and focus on customers. They're more interested in chasing investors than interested in chasing customers, and that is the surest way to lose control of the company and eventually actually end up failing.
Absolutely. I agree with you 100%. It's like you've got to be very, maniacally focused on what is it that the customer wants to buy. And most people are very focused on what they want to sell. So they'll come here and tell you why their product is the best thing to slice bread. They're not telling you about why the customer wants to buy their product. And it's a subtle distinction, but it's a very important
very important distinction.
Yeah.
How do you parse unicorn mania?
I can't say I spend a lot of time thinking about it. On one hand, there's a lot of disruption, both in terms of technology and in terms of how you can get your product or service to people. So there's, we see tons and tons of new things that are disrupting the world. But at the same time, there are new monopolistic companies, Google, Amazon, Facebook, Apple, ones in China, so on, that are also emerging. So the environment is getting tougher and tougher. So I think there's the possibility of having some very large companies, emerge. But on the other hand, these companies like Google and Amazon and so on have extremely deep pockets and extremely strong execution capabilities. So, the number of unicorns there seems to be a bit nutty. But, hey, rich people can spend their money the best way they feel. So they want to.
I make a very clear distinction between real unicorns and pseudo unicorns. The problem is there are a few unicorns in the market, especially in the private market, that are legitimate unicorns, and it's full of pseudo unicorns that have absolutely no legitimacy whatsoever.
I agree, but I don't, it's always interesting to hear the stories and the business models. They're very educational into what has worked for them in getting traction and so on, and try to kind of build good companies that can benefit from that. And I think your point earlier that don't go seeking venture capital if you want to build, like there's a friend of mine, he built just two of them, they built a SaaS company which makes $5 million a year in revenue. There's just two of them. They raise no money. And they have a very nice lifestyle. If two of you are making, their cost is maybe $1 million, so their take home is $2 million each. Hey, that's not a bad thing to do.
Yeah, so, and we have case study after case study of companies that have built incredibly good self-finance, bootstrap businesses at this point. It's
and you don't have to even build big businesses. Just build good businesses that. So I think people should think about that clearly, because with venture, it has to be big and it has to be fast. They say it's patient capital, but it's not that patient.
It's not patient at all. Venture capital is not patient at all. People pretend that it's patient capital. It's not patient capital because the funds are, timed funds. The reason I asked you the unicorn mania question is that, the early stage investors are getting impacted by unicorn mania, right? Because somebody comes in later in the game, loads up lots of accretion preferences, the early stage investors and the entrepreneurs really get screwed.
Yes, yeah. That's true. I think luckily we haven't faced any of that yet. Maybe if outdoorsy gets to be in that unicorn thing, then we'll be, hopefully we'll get a chance to exit before all that stuff happens.
Yeah, I think that's the answer, actually, exiting at the right time.
Yeah.
So my last question before we switch to the mentoring part of the session is, one of my observations, and you kind of hinted to this, is that we are in 2017 and lots of stuff have already been built. Nowadays, there aren't so many wide open opportunities out there, but there are many, many niche opportunities. Some of these businesses need to be built for small amounts of capital, 1 to 2 million, and sold for maybe 10 to 15 million. Some even smaller, maybe invest 250, 500K, sell for 5 to 10 million. What do you think of these kinds of opportunities?
I think they're great opportunities for entrepreneurs. They just have to structure them differently. I mean, if you can, I think there should be a structured way to fund cash flow generating companies. That's something that I'm kind of curious about. I haven't looked at the market. If you wanted to build like this $5 million company that I was talking about, he didn't raise any money, but also he was lucky enough to have the wherewithal to kind of figure out the marketing and the, all of that stuff. There are lots of entrepreneurs that can build, and it doesn't have to be even a high-tech business. I mean, you could be making.
But that's not my question. I think your point is well taken, that there is a whole bootstrapped, business building methodology. We spend a lot of time on that because a lot of the companies that we work with actually should not go and raise money. They should be built, as they're small TAM opportunities, they have to be built without too much capital. The question I was asking was something a bit different, where you kind of you take an opportunity which is not like $1 billion TAM opportunity. It's more like a $100 million TAM kind of opportunity, which is a good tuck-in acquisition. It's better to go to market with products like that through somebody else's channel who actually has the adjacencies, all the core products around which these niche opportunities arise are, sitting somewhere else inside of ServiceNow or Salesforce or Oracle or SAP or somewhere like that. And what needs to happen is you kind of build the product, you get customer validation, but then instead of raising huge amounts of money, you basically sell the company very early. That's my question.
There are actually in Tandem, in our first fund, in Tandem 1, that was our model. We built companies for small acquisitions, and we invested in 8 companies over 2 years, and by the 3rd year, all 8 were acquired. So it was 100% hit rate. And today, that is happening where, I don't know if you know about funds like Fabric. These guys are, a couple of entrepreneurs like a Fabric that come out of the space of the networking space. And they understand that marketplace. They built 2 companies in that space, very well connected in that space. They understand that there's these white spaces that you're talking about. And they find entrepreneurs that want to do stuff in that white space. They themselves put in about $1 million into the company up front. And then they help them raise money, they help them figure out the direction to go in, and then they help them get acquired. So I think
Ravi is doing that in Hive, which they actually don't raise any venture capital. They do it very capital efficient and go straight into an acquisition.
Absolutely. Hive is the same. Fabric and Hive, they were in the same office building for a while. So Hive is doing it in big data. Fabric is doing it in the networking space. I think, there's going to be a lot of these that emerge, and rightly so.
Yeah. All right, well, great talking to you and getting caught up on your activities and how your fund has evolved. When you first told me you were going to do the fund many years ago, you were more in that early stages of thinking through what you were going to do, how you were going to play this game, and it has evolved, obviously, so it's interesting to see your story.
Yeah, thank you.
Okay, folks, we are going to move to the entrepreneur pitch session, and I want to set some expectations here. This is a working session, so our whole reason for being here is to help you put one foot before the other. Whatever roadblocks you're facing, you can come and safely discuss. We have no other agenda besides helping you, and you can feel completely safe. You don't need to feel defensive. However, you will get pretty authentic feedback, so some of it is going to be critique, and you have to be prepared to take that critique and process it. You may disagree with our feedback, that's fine, don't feel bad about that. It's your venture, you will make the final decision on what strategy you're going to follow. But one thing you have to keep in mind, this is a fact, this is a non-negotiable fact, that not all businesses can raise money. Not all businesses should raise money, and raising money does not guarantee success. So please do not get obsessed with raising money. We see this trend in a maniacal way in our industry, so we have to kind of place this caveat at the beginning of the session. So I believe we are going to Alisa Gus as the first presenter from what Maureen is telling me. Is that?
Yes. Hello?
Yes. Go ahead, Alicia. Welcome to the program.
Well, thank you so much for having me. When I contacted you, I didn't really expect it would be quite so fast, but I'm glad I came prepared.
All right, go for it.
Let me talk a little about ourselves. We are coming in as publishers of Curiosity Quills Press. We have been in business for about 6 years, and we are one of the bigger surviving publishing houses in the United States, independent publishing houses. As you know, the ecosystem has been shaped a great deal by Amazon's introduction of Kindle, and then obviously recent changes to the reporting schedules and the introduction of the Kindle Unlimited, which is what they're called KU. And so really what a monopoly gives, monopoly takes away. So the current publishing climate is really hostile, and in fact it's hostile to quite a few businesses in the Amazon ecosystem. So in 2016, my partner Eugene, who is my CTO, we have realized that really what we are doing is putting all our marketing funds into Amazon, and we are unable to then cumulatively market to our people. We are not able to bring them information about future books, and in fact, even if people are, for example, following us on Facebook of their own volition and then post a review, the review gets deleted. So really, it's really quite difficult to form a relationship. However, the market research shows that the customer needs to see a book or needs to see the author's name at least 2.5 to 3.5 times before they actually remember who the author is. So that kind of puts a lot of kibosh on our marketing plans. So we have begun building WishKnish, which is sort of in an initial iteration, we're supposed to be a subscription service for books, both for ourselves and other authors. Unfortunately, as we started speaking to other groups, such as education, such as other vendors on Amazon and beyond, such as real estate agencies, service industries, we realized that this is really a common problem. We need to be able to be in touch with our consumers. So the WishKnish in its current form was born. And what we're really doing is solving the pain experienced by consumers in discovering products and services in a very organic way. Affiliates would be interested in curating content and selling it to their customer bases, and obviously the creators such as ourselves. So what we're really doing is creating a decentralized communities built around our products so that both we are free from oppression of a government, for instance, as it's seen in China, in Russia these days, but also free from the oppression of a big marketplace such as Amazon that's controlling the access to our product and to our communities. Next. Yes, thank you. So really what we're addressing here is a couple of problems. We are creating a stable, recurring source of income, both through the communities and through the subscription, offering a cumulative way to attract customers and keep them with us for businesses, projects, social causes, charities, and political movement. And also making sure that the advertisement is not a money thing just to maintain status quo. What we really need to do is scale our efforts. Next slide, please. Our solution is fourfold. First of all, we're introducing the incentivized referral marketing, which is our way of gamifying and incentivizing our current social groups, both outside the internet and the people that we know in real life, and turning them into evangelizers, fans, and hopefully even affiliates. Which brings us to number 2, which is a deep affiliate integration. It has been validated from talking to people such as Howard Sobel, who is actually head of the department, head of the group of programmers. Actually, they had worked with Amazon for many years. With Microsoft for many years, and they're specialized in specifically affiliate marketing. And the issues here is actually the current internet system is really getting people out of the affiliate system and giving everything to the discovery algorithms. That's not really fair because the discovery algorithms are not always fair. And that brings me to number 4, which is the robust discovery algorithm, which I'm going to speak further on. Finally, the number 3, which I'm going to touch upon, is blockchain-based gamification. Now, why blockchain? We actually came by it entirely organically because we really needed to keep track of the token that really shows how people are working with a particular storefront and the entire ecosystem, how useful they are, how much they contribute, and how they can then use what they have received as the incentivization for further buys or sales on their own end. And that's where we realized the blockchain can come in. It allows for really seamless, transparent tracking, and hence we came to blockchains. First of all, incentivized referral. The whole idea is to gauge interest ahead of the new sale idea of the new product. It allows us to reduce risk, supplement existing business, and grow reach by enabling users such as ourselves to virally convert others. We have this diagram that really shows how it can keep circulating in the system. We incentivize people, we give them an award for joining a group, then they get an award for bringing others in. And then they're actually able to use their rewards in other storefronts within the ecosystem, or to actually incentivize others into doing services for them. Next slide, please. All of this actually bleeds into the deep affiliate integration. Every user can be an affiliate, just as every action is rewarded. Now, the way we do this is, first of all, we create custom referral links to track each campaign, and the campaigns are entirely customizable. So if, for example, a publishing house wants more eyes on the new book launch, well, that's an achievement that they could actually offer to unlock. If it's a restaurant that wants people to try out its new food, the whole idea there is to bring more people to come try out the food. We can do curate and resell third-party products. Creator can decide what percentage they share with an affiliate. It could be anywhere up to 80%, which in that case kind of becomes almost a franchise. You could bundle with other creators and bundle it into multiple products. So that, for example, if you know that one type of wine goes particularly well with some book and also with some crackers, you can create a package that would send each month to specifically these items in it. And obviously it brings value by creating collections of themed products such as Disney hats or anything else you can think of. Now the WishKnish reward token really allows us, as I mentioned, to track all the interactions. It allows users to earn WishKnish via actions that benefit businesses. Just as I mentioned, you get to decide which action generates what kind of rewards and how many of those actions are needed to get the reward. Obviously, users can use their WishKnish to reward other users, and all of this is living on a blockchain, a secure, decentralized ledger which is great for payments on and off the platform. We are actually also working on widgets that can be put up on other sites who are not per se a part of WishKnish, but which can still take advantage of the WishKnish network and the WishKnish discovery. Next slide, please. And that brings me to the robust lifestyle discovery. As I mentioned here, if you're interested in Tesla Motors, you're very likely going to be interested in a candidate that's running on a green platform. Or you might even want to check out a concert by an artist that promised to donate part of their profits to green cause. Or you might be interested in buying a book about green energy. But what we are not going to do is rely on tagging and rank to inform users of the products that they might be interested in. Obviously, there is going to be that component too, but most particularly, we are going to be working towards finding ways to make this really intuitive, and it's something we actually want to base more on Facebook rather than Amazon. Now, obviously, what creators can do is start a storefront, invite existing contacts through email, social, just a word of mouth. Eventually, we want to be able to do it through QR codes and so on, and incentivize them to help engage everyone, to bring in other users, to reach out, to learn more about the products, and get rewarded for it, which they can then reuse on just about any other site as a normal currency. So basically, here we list our project roadmap. We are about 95% complete at phase 1. We meant to finish it by December of 2017. We are running ahead of time. The phase 2, which is the crowdfunding campaign, Wish Bounty, and so on, is in fact going to move a lot faster because we are working together with a carry group, which we are probably going to be taking over or at least joining forces with to take advantage of their deep communication network. So a lot of that is going to be simplified. And we'll be jumping down to phase 3, which is the site widgets that I mentioned, web browser programs, and so on. And in phase 4, we are going to be really enlarging on a talent exchange, which we can already use right now as a basic storefront for gig economy. We really want to move forward into a lot deeper integration and trust system, which can be used as a direct employment right there within WishKnish. Now, I should mention that we have a really low commission fees on any interactions within the site.
Alicia,
so,
I'm going to stop you at this point. You know, we've heard your presentation for a good 7-8 minutes. And to be perfectly honest with you, I have absolutely no clue what you're doing. I don't understand it. Sunil, do you understand what she's doing? Anyway, so what about the audience? Do you understand what she's doing? I will tell you what worries me with what you're presenting here and how you're presenting.
Okay.
You know, the best way to present is that what is the problem that you're solving? And how are you solving that problem? And how are you making money? Can you explain to me what problem are you solving? Are you helping people set up affiliate networks for their products? Is that your primary value proposition, products or services?
Okay. All right. What we're really setting up is, I guess, okay, the simplest way is we're allowing people to set up their own storefronts, and then we're allowing them to put together affiliate networks. So in a way, we're getting people an opportunity to set up their own micro Amazons. It's entirely decentralized, so in a way, you're running your own storefront by your own rules, but they're all a part of an affiliate network that's joined together by discovery and the common. So
you have some sort of a storefront platform product, like
yes.
Are you talking about like a Shopify kind of platform where you can
yes.
Somebody can set up a storefront, and then you're also helping them set up an affiliate program for that storefront. Those
yes.
are your two primary value propositions. Is that accurate?
Yes, it is.
Okay. So, and where are you with this business? How are you charging? So, do you charge a subscription fee to the people who are on your platform?
No, it's actually entirely free. No, it's entirely free. Now, we would be charging 7% commissions for fiat currency, which is your USD, your ruble, your pound, and so on. We are charging 5% for cryptocurrency, such as Bitcoin and Ether. And we are charging right now 0% for any WishKnish transactions, but we will be charging 2% for the transactions that are conducted in WishKnish once the ecosystem matures. And additionally, we would be charging fees for advertisements, for email blasts, and for certain enterprise level features. But the basic storefronts would be free to use.
Okay, so I think the problem I have with this is that there are many storefront products out there for very, very small amounts of money. You know, the Shopify, BigCommerce, Volusion, these are very, very inexpensive products. So if somebody doesn't want to be on eBay or Amazon as their primary storefront, they have many, many options. So I'm not convinced that that is necessarily a good business, and I personally do not like businesses that are free, essentially. So you're assuming that you're going to get enough customers who are going to get on your storefront that you can make money off commissions, and it seems to me that this is going to be an uphill task from a getting things off the ground point of view and getting to some sort of traction. So where are you right now? Do you have a product out? Do you have customers who have put their catalogs on who have set up storefronts, put their catalogs, and you're actually selling? Or is this all in concept stage?
Actually, we are in beta right now. We have been in stealth, but we do have about 40 enterprise launch partners, and we have about 50,000 users that are bringing in. So we are going to be doing the hard launch and beginning to sell at the same time as we are doing our ICO, which would be November 15th. Additionally, we have about 40,000 people coming in through the carry side. So we are launching with 90,000 people, and the ICO typically brings in another 50 to 100,000 users, which is our initial pool.
And what kind of enterprise partners are we talking about?
Excuse me? Enterprise
what kind of enterprise partners are we talking about? You said you have 40 enterprise partners.
Yes.
What kind of enterprise partners are we talking?
We are talking about a fashion house, we are talking about a magazine, we are talking about Dazzlecon, we are talking about company that creates smart suits that are used in filming.
These are people who want to set up storefronts on your platform, or these are some sort of a distribution partner? What do you mean by enterprise partner?
No, I'm talking about there are basically bigger companies that are going to be selling their services and putting their catalogs with us. And additionally, I'm talking with IBPA, which is Independent Publishers Association here in the United States, and they might be coming in with all their users, which would be about 10 to, well, at least recommending us to about 10 to 50,000 different sized publishers as well.
Well, maybe you know something that I don't.
Well, the whole idea that is really all about incentivized referral marketing, and we really want to be able to allow people to incentivize and track the referrals that they give. As they would call it in Russia, we are calling it sarafan economy, which is basically people telling people about something that they like. But there has previously been no way to get rewarded for this kind of thing, or really for speaking up and for becoming both an affiliate and an evangelizer for a service. We want to make it simple, easy, and trackable, and we want to make the percentages, obviously the commissions, really low to keep it attractive. Coupled with the discovery, at least so far, it seems to be a great proposition. We're hoping that just this aspect of incentivization is going to allow us to grow in terms of each user, at least 8 to 10% of users being able to bring in their customers and storefronts, which allows for exponential growth.
And how are you financing this phase of developing all this?
We have been entirely bootstrapped. Yeah, we have been entirely bootstrapped until now.
How long will it take you prove out this hypothesis, the traction so far slide that you have here, you are saying that you have all this pipeline and so forth. How long will it take you to start generating revenues based on the assumptions that you have here on this slide?
Actually, I'm pretty sure that we'll begin, I wouldn't say we're going to be cash flow positive, but we were going to begin generating, I would believe, by the first quarter of 2018.
Okay. Well, to be perfectly honest with you, I don't have enough data to assess how realistic that is. And you know, you seem to be very confident that you are going to be achieving these numbers by first quarter of 2018. So I wish you absolutely the best.
Well, thank you so much, and I hopefully will get a chance to speak about it later and see if I can manage to validate my assumptions.
All right. Okay, so it looks like there's a bunch of people in different parts of the world who have connectivity issues. One of the presenters in Bangalore has weather-related connectivity issues. Another presenter from Nigeria is having connectivity issues, and another presenter, this one, Ajanta, is in the subway and in New York. So, all right, well, I'm going to move on and explain to you how to use 1M1M, and we'll see if other people show up and solve their connectivity issues. We've never had 3 presenters in one session have connectivity issues. But there's always a first in 371 sessions. A lot of surprises are likely. So if you like what we are doing here at 1M by1M, please refer the program to people who are open to constructive critique. We are very focused, as we said in the discussion with Sunil earlier, on customer revenue and profit. Financing is something that we do, and it has its own requirements. Unfortunately, as you heard in Sunil's presentation today, as well as if you have been here before in other presentations, this topic is coming up constantly. Investors want to fund businesses and not concepts, not MVPs. They want to fund businesses. And for a startup to become a business, there is quite a bit of runway that needs to be traversed. So if you are saying that you have, you know, such and such deals that you think are going to convert into revenues, by the time investors are willing to work with you, you're going to have to show validation of those assumptions. It'll be difficult for you to find people who are willing to fund assumptions. And the problem is this whole spectrum of pre-seed, seed, post-seed, pre-series A, all of this is predicated upon the fact that you have done some of the validation work yourselves on your own dime. So we want to work with entrepreneurs who understand these complexities, not come here with unrealistic goals which we are unable to meet. If you have this goal that you have a concept and the concept is going to get financed by some investors and we are going to help you raise that money, this is an expectation that we cannot help you with. We can help you raise money. There's no question. We've helped lots of entrepreneurs raise money. But there are, you know, specifics to the requirements of what investors are looking for. You're going to have to work with us, and we're going to have to work with you to get you there. Then we can introduce you to investors in our network who would be willing to make those investments. So all resources from 1M by1M are at the website, and you are going to find a terrific blog, really rich, very, very informative educational blog. You'll find the Entrepreneur Journeys book series, which is full of interesting information. 12 to 16 case studies per book. Double-click down on a topic. If you're learning how to bootstrap with a paycheck, or if you're learning how to build an e-commerce business, there's dedicated books on each of those topics. So please look any of those up. These roundtables happen every week. So now until Thanksgiving, we still have every Thursday a roundtable. Our full acceleration program is 1M1M Premium. We offer full methodology guidance, an online curriculum that you can do at your own time to plug your methodology gaps. We help you with business development. We help you with financing. We help you with project coaching, strategy consulting, and we have a lot of clout in the media, so you can access our network to also get media coverage. That's a $1,000 annual membership fee program. We recommend that you do the 1M1M self-assessment. This is a questionnaire that is going to ask you a bunch of strategic questions that normally investors would ask you. We are asking you to ask these questions of yourselves so that you can be several steps ahead. And if you run into methodology gaps, do 1M1M Basic to plug those methodology gaps. That's a monthly subscription program, $99 a month, curriculum only, and you can plug all your methodology gaps using that as your learning material. So go dig around on our website and see how you want to engage with the program. You can find what to expect from the different programs, premium, basic. There's lots of FAQs, lots of video FAQs, etc. The curriculum is rich. There's description on the curriculum you'll find. We are a case study-based program. We have had over 750 successful entrepreneurs participate in the case study program, and based on their strategies, tactics, how they put one foot before the other, we build this program so that you can stand on the shoulders of these very, very successful entrepreneurs, including 50+ unicorn entrepreneurs, 400 venture-funded companies, 300 bootstrap success stories. So there's a ton of resources you get that is essentially tried and true strategies that will help you learn from them. It simulates the experience of having coffee with all these very successful people who are willing to be generous and teach you. Our methodology is lean, capital efficient bootstrap startups. Even if you raise money, you're going to need to bootstrap first. By using the strategy bootstrap first, raise money later, we have helped a lot of entrepreneurs get very far. The company in our portfolio that has raised the most money has raised $149 million. So yes, you can raise money, but there are things that you need to do to get there. Okay, upcoming free roundtables, October 19th, 26th, November 2nd, 9th, and 16th. We also have these in-person meeting opportunities based on years of requests. So on Thursday, October 19th at 8 p.m. Pacific time, you can come and meet with me at Cafe Boroni in Menlo Park, if you like. Just hang out at Cafe Boroni. Similarly, November 9th, December 13th, same place. You can come and talk to me at those sessions in person. That's pretty much it in terms of introducing you to 1M1M. We are ready for further Q&A, and I believe some of the people who were lined up to pitch today, Anurag Tiwari and Emma Mayaki, are in the room. Anurag, are you dialed into the call? I have a question from Rishi Gupta. Do you ever do these cafe meetings in New York? No, we don't. I live in California, in Silicon Valley, so the only kinds of meetings we do are in these rendezvous, monthly rendezvous in Silicon Valley. If I am traveling, sometimes I do rendezvous in different cities, but very rarely. I have a bunch of private messages from people. I suggest you not send me private messages. Send write your messages in the public chat so that everybody can read your messages. For example, Ofer Markman actually has a public message. We will bring our companies from our hub. Ofer, maybe you want to introduce more about your hub in the public chat as well, or if you want to call in and do so, that's fine too. Valinder Mangat has sent me a private message saying, love what you're doing, just heard a series of your podcasts. I'm an entrepreneur that is building solutions in drone space and fit in the category you talk about. Niche solution that may not be a unicorn, but good enough for 15 to 20 million. Okay, that's great. Rishi Gupta is asking me to come to New York City. Okay, well, line is open. You can call in or you can continue to chat in the public chat. Please make sure you set your chat to send to all participants. And let me also introduce you to Irina Patterson, Irina at 1Mby1M.com. She will be very happy to answer questions about the 1M by 1M program. Ofer Markman says our hub is a small third world focused life science oriented hub. Ofer, this program is IT and IT enabled services only. We don't do life sciences. We do healthcare IT though, but not life sciences. We don't do drug discovery. We don't do medical devices. Anybody else? Questions, comments? Introductions? Okay, perfect. Healthcare IT is a very good space. We do a lot in that space. So please feel free to bring your entrepreneurs in. Where are you located, Ofer? Haifa, Israel. Okay, great. Awesome. Anybody else? Any other questions, comments, introductions in a most scenic location? Great. All right, folks, I don't see any other questions, so we're going to wrap up for today and meet you back here, same place, next week, and look at more of your businesses, work with you. Remember, this is a working session, so we will continue working with you. Bye, everybody. Thank you for coming.